under pressure is Borosil. So pull up the intraday chart of Borosil. You would see a decline of nearly 9%, opened with a cut of 15%. The company recently reported its third quarter numbers as well, where net profit and margins came under pressure due to increase in other expenses. So to discuss this and more on demand trends, we have Shreevar Kheruka, who's the MD and CEO of Borosil, joining in. Thanks a lot, Shreevar, for joining in. One of those rare days where, in the morning we got to speak to Mr. Pradeep Kheruka of Borosil Renewables, and that stock was higher. He foresees the future to be a lot stronger. And then in the afternoon, we get to speak to you as well. Both stocks in different directions today, but a rare occasion. So be that as it may, let's talk about your third quarter numbers itself. Two things disappointed the street. One was the lack of revenue growth, or revenue growth being at the lower end of what the street's expectations were. And secondly, your margins coming off as well. I was looking at your conference call details. You said that the lack of revenue growth was largely because of B2B going off because of the new rule coming in with regards to sale or uniform code for pharmaceutical marketing practices. And the second part is to increase your e-commerce sales. You had to increase the cost of customer acquisition, and that impacted your margins as well. On both these fronts, if you could give us some clarity, how much do institutional sales account for in your overall mix? How much was that impacted by? And secondly, what proportion of your sales come in from e-commerce, and what are the margin differentials between e-commerce and other sales?
Well, thanks for having me. Well, firstly, I'd say that we actually did not have a bad sales growth. It was, if you look at the first 9 months, we were somewhere in the 16 to 17% revenue growth area, which I believe is leading, amongst, say, our peer set. So in the last few years, of course, we've been growing more in the 20 to 25%. So from that perspective, yes, it's a bit lower, but we've always guided for a 15 to 20% CAGR, and we're currently somewhere in the middle of that. So that being said, yes, as far as margins are concerned, there were actually two separate impacts. One is what I would say above EBITDA, and one is below EBITDA. So, as far as below EBITDA is concerned, I think we've started a new plant last March for borosilicate pressware, which is the one of its kind in India. And, the depreciation has come into the balance sheet, or rather to the P&L statement from there, which has, dented the PAT margins or the PBT margins. As far as above the EBITDA line, I would say, yes, the 2 points you mentioned, corporate gifting specifically from pharmaceutical companies has been, much lower this year compared to the years past. I wouldn't like to exactly give you numbers because we don't share the channel-wise sales breakup. But I would say it's taken at least 2, 3, 4% of our overall top line sales growth. So that has been a negative. As far as customer acquisition costs are concerned, we do see our basic strategy is we must reach the end customer. We love all our channels, but we love the customer more, and therefore the customer must be able to access us from wherever she or he desires. So at the moment we have seen increasing revenue share in, say, e-commerce, and this is since the COVID phenomena, e-commerce as well as in quick commerce. And there you do need to spend more on advertising. So there has been a higher advertising cost as a result of that. But I would say in the long run, or let's say medium run, we have guided to an EBITDA improvement to between 20 and 22%. And that doesn't change because of one quarter. So that's likely to continue to be our goal in the medium term. And we are quite confident to achieve it. Also, one more thing that's changed, since the last quarter, of course, I think the budget was very positive from the middle class perspective, with more money in the hands of the middle class. And therefore, we do hope and we do expect that discretionary spending for household items will increase post the budget announcement. So in general, I would say we are going as per plan. One quarter down doesn't really do much. There's no longer term, negative story here.
What proportion of your sales currently comes from e-commerce versus what it was, say, pre-COVID? And how much are your ad spends as a percentage of sales? Where is that number likely to stabilize at?
Yeah, so as far as the ad spends are concerned, we are roughly around 8% of sales, which is much higher than the industry average. And in the past, it used to be 10, it's come down to 8. And I believe in the next, as we scale, operating leverage will allow us to get to about 6. So we should add another 2 percentage points in EBITDA from there. The other point is in terms of, like I told you before, we don't really share channel-wise sales mix for competitive reasons, but I would say e-commerce has multiplied manifold compared to before COVID, and we see that trend continue.
Not the exact number, but a broad range if you could give us, low teens, mid-teens, mid-single digits, high single digits.
It's definitely in double digits. It's definitely in double digits, but and it's rising rapidly.
Shreevar, if you could, we are facing paucity of time, but if you could help us, number one, FY25, where will you end in terms of top line margins as well as PAT? FY26, what is the outlook like? If you can't quantify it, can you give qualitative outlook as to how exactly you see FY26 pan out?
Look, as far as the growth is concerned, if you look at the 9 months average, we've grown 16-17%. I don't see any reason why that should change in the last quarter. So you could just, multiply that. And I would hope that we could continue that same momentum in the next year. And as far as margins are concerned, I would say we're at about 17% operating EBITDA margins. And our goal is somewhere in the 21-22 range. And probably we should be able to add 1 or 2 percentage points to that 17% in the next year and hit that 21-22 probably somewhere in FY27.
Just a quick word before we let you go on your opalware business and your non-glassware business. Non-glassware has been a growth generator for you. Wondering whether you are looking at, manufacturing non-glassware products in-house versus completely outsourcing right now, because you're working on a few categories there as well. And in opalware, you are expecting some competition coming by. So will that impact your margins going forward?
Well, as far as non-glassware is concerned, we absolutely have grown that business a lot. We do expect, or rather the government has been, encouraging companies to make in India, and we are fully, cognizant of that. And therefore, we do have plans to set up non-glassware manufacturing in the near future. Those plans haven't yet been fructified into a formal, approval from the board, which should happen shortly. Once I have that, I will definitely share that with you. But in principle, yes, we will be manufacturing some non-glassware in India in the short run. And as far as opal glass, yes, competition is coming, no doubt about it. There have been, there was a 1-player industry, now it's a 3-player industry. There may be a 4th player coming, no doubt. But these are all well-established and I would say mature players. And I don't think that margins should hurt because of that. I mean, it's only that the industry will take more share from competing, say, dinnerware, let's say, segments like maybe ceramics. So I don't believe the margins will be impacted from that.
Right. Thank you so much, Shreevar, for joining us, giving a sense of how Q3 panned out and how exactly you see the competitive landscape pan out. Well, we'll now shift into a short break, but here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.